Hi, this is Anubhav from Find My Real Estate, and today I want to walk you through why people are freaking out for nothing on an interest rate that's just gone up by 0.25% in the month of February. So I'm going to take an example of a $600,000 property, and I'm going to show you the actual breakdown of what that looks like in terms of how much negative you would be if you were to buy an investment for $600,000 property, and what the rent would look like, its expenses, and typically what a negative gearing would look like. So let's go back to the drawing board and show you exactly what's happening. So our purchase price is for $600,000 as mentioned here. And the cost to actually buy the property, which includes your stamp duty, your conveyancing cost, your building and pests, and maybe if you're using a buyer's advocate, all fees inclusive, it's approximately about $60,000 that we have over here. So I've taken about total 10% cost on a $600,000 property, which means your total acquisition is for $660,000 right here. Now, if I look at how much loan are we going to take on a $600,000 property, that's going to be around 80%, which means the loan amount will be $480,000. And the total amount of money I need to buy a $600,000 property is going to be $180,000. Now, this could be in form of cash sitting in your bank, or it could be another investment property or your home where you can draw the equity out by talking to the right broker and banker, and you can use this money to buy your next investment property. And most likely, the property that you are going to buy as investment, and this money, if you're pulling out from equity or even using it for the purpose of buying that property, it means you should be able to claim deductions on that, but talk to your tax accountant for the same. So going back to our example, we have $180,000 that we need to acquire a property for $600,000, and the breakdown of $180,000 is $120,000 that we need as a deposit, and the $60,000 that I have here is what we mentioned as your cost. So that makes it total $180,000. Now, if the property purchase price is lower, you're going to need obviously less money. If you're going to buy a $700,000 or $1 million, the actual breakdown looks exactly the same. So going back to the number, $600,000 purchase price, cost is $60,000. You need $480,000 as loan, and pretty much your equity position is going to be around $180,000 or cash required to buy the property. You don't have to borrow 80%. You could even borrow 90% as well. And let me show you the numbers, what that looks like. So on a 90% loan, your loan amount is going to be $540,000, which means your cash that you need for this property is going to be $60,000 deposit plus $60,000 for the cost, which is going to be $120,000 instead of $180,000 as well. So that is also possible. If you don't have $180,000 equity, you can get $120,000 equity. So that's how the purchase looks like for a $600,000 property, which you can buy properties all over Australia, whether it's in Queensland, South Australia, WA, Tasmania, or even for that matter in Victoria, because we specialize in such markets that are actually booming for growth and actually giving you the right returns. Now let's talk about cash flow, and the real purpose of doing this exercise was interest rates are going up, people are freaking out. What does that really mean in terms of cash flow? So we're going to go back to our example of $600,000 property, as I mentioned, but for the purpose of actually calculating that rental and the expenses and the negative gearing, we will consider that you have borrowed 80%, not 90% in that scenario, which is back to $480,000 loan and $180,000 cash or equity that you need. All right, so now let me show you what does the actual holding cost look like for you when you're buying a property for $600,000. Now, we have assumed that you will get a yield of 4.5% in the market, especially in which we buy the properties for our clients, which is easily achievable. Your rental for the year is going to be $27,000, which is 4.5% of your purchase price, which is right here. That is $600,000. So the rent is $27,000 that we are getting, and the assumption is it is rented for 52 weeks in this scenario, which is quite likely and possible in very tight rental markets that we buy properties in. The next item is the direct expense of the property. Now that's $9,450. This is a very rough order of magnitude, but it covers almost every line item that is linked with your expense. For example, rates, property management, maintenance, land tax, and anything else that you consider, like insurance that you may have. You might have building insurance, you might have landlord insurance. You should be putting that cost against this line item, which is a direct expense to the property. In this scenario, we've taken a rough example of 9,450, which is quite reasonable to expect that 35% is the cost of the actual rental that you're getting. Then the major part of the outgoing is going to be an interest component on a residential property. So we got to factor that in as well, which in this scenario, if your loan is for $480,000, as we said previously, 80% borrowing, and the current interest rate, which has gone up from likely from 5.75 to 6%, then we are looking at an interest of 28,800 right here. Now this is the interest that basically takes away a lot of our outgoing, which means that your negative position or negative gearing is 11,250. After we add the rent minus your expense minus the interest, you are left with 11,250 on annual basis, which means approximately you are going to be close to around $900 to $950 per month out of pocket to hold an investment property like that. So what has actually changed in the month of February? So prior to actually getting into interest rate hike in February, our interest rate would have been 5.75, which I've actually done a calculation here that at 5.75, we would have actually seen an interest amount to be paid as 27,600. And that actually means that our negative position would have been 10,050 instead of 11,250, which is a difference of $1,200 that you can see here. It actually means that $1,200 is about $100. So your cost has gone up by $100 with a 0.25 increase in interest. Now let's say another interest rate actually happens in the next few months, which is quite likely with the way we are going. But what does that actually do? It actually means that you are adding another difference of $1,200 to that whole component. That means your actual negative position will be 12,450, which means your total interest is going to be $30,000 on a 6.25 interest rate. Now, is that really bothering you? Imagine your cost of opportunity of not doing anything right now. It's very high. On a $600,000 property, if the property moves even 5% in value in about, let's say, a year's time, that's a $30,000 increase in equity. So for merely $1,200, are you willing to lose $30,000? Smart investors take this as an opportunity to create wealth and not sit with the 99% people who are sitting on the fence wondering when interest rates will go up. So if you really want to know what it looks like for you, give us a call and we can help you.